On September 16th, 1992, one man made $1 billion in a single day by betting against the British government, against the central bank of an entire country, an institution backed by the full resources of the British state, which had publicly promised for weeks that it would never back down. The government lost. George Soros won. The British pound collapsed, interest rates jumped to 15% in a single day, and the Chancellor of the Exchequer had to go on television to announce a humiliating retreat. What Soros understood that the entire British elite failed to grasp wasn't luck or genius. It was a particular way of thinking about markets that almost no one uses. Today, I want to show you what it is. Meet Mia. Mia works in marketing at a tech startup. Smart, curious, reads the right newsletters. She opened a brokerage account 2 years ago and checks it roughly 40 times a day, including, let's be honest, on Zoom calls with her camera off. She watches the right channels, understands PE ratios, follows earnings season, knows what the Fed is doing, and she still loses money more often than she makes it. Not because she's wrong about the fundamentals, she's usually right about those. She's wrong about something she doesn't know she's missing. The same thing the British government missed in 1992. The same thing most investors miss every day. Markets don't work the way Mia thinks they do. Soros figured this out. And once you see it, you genuinely can't go back. Soros's quantum fund averaged 30% annual returns for over 2 decades. The S&P averages around 10%. He didn't beat the market. He made the market look like it was standing still for 20 years straight. Before Soros was a billionaire, he was a teenager in Nazi-occupied Budapest, learning the most important financial lesson of his life. Not from a textbook, from survival. His father forged documents for Jewish families hiding from the Nazis. Young George watched him do it. Watched him understand that reality isn't fixed, that perception can be constructed, that the gap between what people believe and what's actually true is something you can work with. He carried that to London, then New York, then Wall Street. By the 1980s, his quantum fund was making money so consistently that other funds stopped trying to figure out how and just started copying his trades. His colleagues said something strange though. His fundamental analysis was average. The thing that made him rich wasn't his ability to read a balance sheet. Soros used back pain as a trading signal. Literally. When a position felt wrong, his spine started hurting. He'd use that discomfort as a sign to reassess. His son Robert said the theories mattered less than his ability to sense when something was off. That sounds like a weird billionaire thing. It's actually a clue to everything. His edge wasn't data or models. It was a completely different understanding of what markets are. He called it reflexivity. Here's how most people think markets work. The economy is the temperature of the room. The market is the thermometer. Slow sometimes, occasionally wrong, but eventually it corrects and shows you the true reading. Prices reflect fundamentals. Soros said that's wrong. Not slightly off. Wrong at the foundation. Markets don't just reflect reality. They participate in creating it. When investors believe a currency is strong, they buy it. Buying makes it stronger. That strength attracts more investors. More buying makes it stronger still. The thermometer isn't reading the temperature, it's heating the room, and it runs in reverse. Doubt a currency and you sell. Selling weakens it. Weakness creates more doubt. The belief produces the thing it's a belief about. Soros called this feedback loop reflexivity, and he built his entire approach around one observation. These loops overshoot. They go further than fundamentals justify in both directions. A currency strengthens beyond reason. A stock climbs past earnings. A narrative runs until it snaps. When the loop breaks, the reversal is violent. Everyone who wrote it up tries to exit through the same door at the same time. The job isn't predicting fundamentals, it's spotting when the loop is about to snap. In 1992, the Bank of England had roughly £44 billion in reserves to defend the pound. Soros alone shorted $10 billion. When other funds joined, because he was telling people openly what he was doing, the selling pressure hit tens of billions per hour. The bank ran out of ammunition before lunchtime. By 1992, Britain had been in the European exchange rate mechanism for 2 years. The ERM locked European currencies within fixed bands. Britain committed to keeping the pound at roughly 2.95 German marks. The problem? Britain was in recession. Unemployment was climbing. The economy needed lower interest rates, cheaper money to stimulate growth. The ERM needed high rates to keep the pound's value attractive. You can have the peg or you can have the recovery. Pick one. Here's where Mia and Soros look at exactly the same data. Mia sees a government that has publicly, repeatedly, loudly committed to defending the pound. The chancellor said it, the prime minister said it, The Bank of England said it. Mia trusts the commitment. Soros sees a reflexivity trap. The commitment wasn't a defense, it was a target. It told the market exactly what price to attack and guaranteed a counterparty with deep but finite resources. The louder the promise, the more certain the collapse when belief finally cracked. A narrative in markets is only as strong as the people maintaining it. Start enough selling, erode enough belief, and the thing collapses under its own weight. The government promising to defend the pound was like a bouncer swearing nobody leaves the club. Sounds tough. Everyone rushes the exit at once. The bouncer becomes irrelevant. September 1992. Soros starts building his short position on sterling. Not quietly. He tells people what he's doing and why. Other funds start following. The selling pressure builds. September 16th. Black Wednesday. The bank spends billions buying pounds to hold the rate. It holds briefly. Rates go from 10% to 12%. Still not enough. They announce 15%. 15% interest rates in one day. Britain's mortgage holders woke up to a nightmare. Didn't work. By evening, the pound fell below the floor they'd sworn they'd never breach. Britain withdrew from the ERM. Interest rates were cut back the same night because the thing they were defending was already gone. Soros closed his position. $1 billion. One day, he later said he underbet it. He could have made more. The man who said he'd break the Bank of England did it, then complained he didn't go big enough. Either the most confident thing I've ever heard or the most terrifying. Probably both. After Black Wednesday, Britain's exit from the ERM turned out to be exactly what the economy needed. The cheaper pound made exports competitive. Interest rates fell. GDP accelerated. Unemployment dropped. The humiliation the government fought to prevent was the medicine the economy required. The thing the market forced on them fixed the problem. 3 principles. The first one is going to sound wrong. Markets are always wrong. Not sometimes. Not in edge cases. Always. Structurally, by design. Think about what a price actually is. It's not a measurement of value. It's a record of what a bunch of people with different information, different fears, and different timelines agreed to trade at right now, in the current mood of the room. That's it. Nobody has the full picture. Everyone acts anyway. The price gets built from thousands of incomplete views, and then the price itself changes the views of the next 1,000 people who see it. The map is permanently different from the territory. Practical implication: stop looking for the correct price. Ask what the current price assumes about reality, and whether that assumption holds. Mia asks, is this stock cheap or expensive? Soros asked, what story is this price telling? Who's maintaining that story, and what breaks when they stop? Same stock. Completely different question. Second principle, the trend is your friend until the bend. Soros wasn't a contrarian who fought momentum. Reflexivity means trends overshoot, so he rode them. Rising currencies, booming sectors, narratives gathering steam, he bought into those, not against them. But he was always watching for the break signal. What does a breaking loop look like in practice? Prices still rising, but the buyers getting thinner and weaker, the story requiring more suspension of disbelief than it used to. Insiders quietly exiting while headlines stay positive. The gap between the narrative and reality getting too wide to paper over. When it breaks, it doesn't gently reverse. It cracks. Everyone exits the same door simultaneously. The reversal is faster and nastier than the rise was. The edge isn't being contrarian, it's reading the stress fractures before the collapse. There's almost always a window where they're visible. Most people aren't looking for them. Soros once said, it's not whether you're right or wrong that matters, but how much you make when you're right and how much you lose when you're wrong. Most investors optimize for being right. Soros optimized for asymmetry. That single distinction explains most of the gap between his returns and everyone else's. Third principle, your biggest positions should be when you're most right, not most comfortable. Most investors spread risk evenly. Diversify. Keep positions small so no single bet hurts too much. Sensible, defensive, ordinary. Soros concentrated massively when he found a clear reflexivity trade, narrative and fundamentals pointing in opposite directions. Reversal predictable even if the timing wasn't. The pound trade was his entire fund plus borrowed money. One bet. He didn't hedge it. Most investors go biggest when they feel most confident emotionally. Near the top of a trend, when the narrative is most seductive and the story sounds best. Soros went biggest when the structural analysis was clearest, often when the narrative was still running, but the mechanics were already broken. Uncomfortable to buy. Obviously correct in retrospect. His back stopped hurting. That was a signal. In 1992, Conventional Wall Street wisdom said betting against a G7 central bank was suicidal. Soros did it anyway, then told other hedge funds what he was doing. Those funds joined. The conventional wisdom was exactly why the trade worked. Everyone who believed it was on the wrong side. Here's the part that doesn't make it into most Soros profiles. He got it wrong. A lot. Shorted the dollar in the early 1980s. Lost heavily. Bet against Hong Kong's currency peg in 1998. Same playbook, same reflexivity logic. The Hong Kong government defended it successfully. He lost hundreds of millions. His framework wasn't a cheat code, it was a lens that made certain things visible that other lenses miss. The lens was sometimes pointed at the wrong thing. He just knew how to be wrong cheaply and right expensively. That's the whole game. Mia's still watching that second monitor, still checking the portfolio during calls, still asking whether things are cheap or expensive. She's missing the meta question. What does this price assume about reality? Who's maintaining that assumption? What breaks it? Markets are voting machines where the votes change the thing being voted on. That's an unsettling way to think about money. It's also closer to accurate than the thermometer version. Pick something you own right now. Ask what story the price is telling. Ask whether that story is still holding. That's the first Soros question. It's free and it will bother you more than you expect. After Black Wednesday, journalists asked Soros how he felt about making $1 billion while ordinary British people saw mortgage rates spike. He said, "I didn't create the problem. The government set an unsustainable rate and made promises they couldn't keep. I noticed before everyone else." Whether that answer satisfies you probably says something about how you think markets should work.